Welcome viewers to another Inventors Studio business workshop. My name is Michael with Alchemy Design, a design company working with inventors, makers, and innovators to move their technologies forward. To read more information, you can visit our website, alchemy.design. Today we'll be going through an example of building your financial estimates. Once you've actually established your customers, your market segment, and you have a preliminary approach to reaching those customers, the next thing you're going to want to do is start to build your financial model. And it's also one that you'll continually update throughout the rest of building your business. This step is crucial to communicating your business model, its forecast, expected cash flows to investors, but it's also a tool for you to better understand the value and health of your company. And we'll talk about some of those aspects of the benefits of doing this as we go through the example. You should walk away from this video with a better understanding of how to build estimated financials and the tools to do so. This topic, of course, is for startups. If this is your new business and you're going right from scratch, it's a great place to start. But also existing companies who are exploring new business, considering a new service or software, product, or a new business unit, or even program. Building financial estimates on those programs is a great way to understand what you're going to need to operate it and when you go to communicate and looking out there for money. I recommend that you watch this video and then use it as a guide to develop and doing your own estimated financials. So don't try to do it as you're watching the video the first time. But go back to it as a reference. If you do come up to using different resources to make estimates, make links or connections or mark those references, as well as making notes on those estimates, such as percentages you've used or costs that you're estimating and why you chose that amount. So as your understanding of your financials and your markets evolved, you're going to be making changes constantly to your business model, to your go-to-market plan, your market size estimations. All that's going to change. So what I'm trying to provide here in all these presentations is tools just to make that a little bit easier. These are simple tools. You can get into more complicated ones later, but this is just a great place to start is with these tools. So be sure to watch some of the other videos if you haven't. So during these topics, I do try to align the different areas to the business model canvas. It's a very popular tool that's used in lean startups and things like that. If you're not familiar with it, Business Model Generation book by Alexander Oswalder is what I reference and use a lot. In the description of the video, you can get a link to where you can find that book. So by creating financial estimates based on what you already or currently know and assume in your business, allows you to learn aspects more about your customers, the channels, your costs. And this is the same with every tool that I have, what key resources you might need and partners. But also, once you start to get into financials, you're going to start getting a feel for cash flow. And we're going to show some really good examples of, like, even though your financials might look great, once you look at your cash flow, not so great. So it helps you understand those financial needs, so then you can assess the value of what you are offering and make informed decisions about when you maybe need to hire people or when you need to ask for cash, or if you think you need to pivot or change your prices. And also then you can communicate that a lot easier to stakeholders. As with all the other examples, we're going to use Apex Bikes as the example. Might be some changes in there from the information we saw before, but it is a fictional company. It's not real, though it does use some actual market information that was collected a while back, a few years ago, but the content and the use of it is relevant. So with that, we're going to get started. So we'll get the presentation going and we'll start going through the presentation part of it. And then we'll start going through an actual example of a financial model buildup and kind of what happens as you start adding numbers. So let's do it. All right, getting started with income and cash flow statements and building financial estimates. Again, Michael Archimede Design. We're going to go through an example with Apex Bikes again. It's a continuation of the other series of things, getting into starting to make assumptions about financials and actually building a model for Apex and seeing kind of what happens as we add numbers in the fate of cash flow. But first, we're just going to go through a presentation to kind of making some introduction to the basics of financial statements. Not everybody is an accountant or understands financial statements, so we're going to go through some of those things and some different resources. So let's get started. So as I said, I like to base a lot of these things on and talk about how they tie into the business model canvas. Call it metrics that matter. I don't go into detail about the business model canvas other than how this can relate to it. The hope is you'll pick up the book and read the book and then start to understand that as you're building a canvas out, how would you use tools like this to answer questions or check the box that you've covered that aspect of the canvas. Within this, things that you can pop out from working on financials is looking at your key activities, what you need to be doing, what your costs are, or key resources you might need. Customers, obviously, you have to know what your sales targets are going to be, and could dip into customer relationships as well. Then, how do you make revenue? Do you need to consider anything with channels? So all of that kind of feeds into this a little bit. So continuing with that, value proposition. Do you have the right product at cost? Cost plus versus value add. What's your market size and share? Any competition that's out there you need to be aware of, and how maybe you match up to them or can better compete against them. Customer relationships, as we said, how do you acquire customers? How do you keep customers? How do you convert customers? Is there a lifetime value associated with a customer? We're not going to get into those details within financial modeling, but these are things that you're going to develop over time to keep an eye on. Market type, we've talked about these before. Are you selling more than one product to different customer segments? Is your, in this sense, maybe it's multi-sided. Are you cloning an existing business and just repeating it in a different type of market? These are the types of things to understand as well, because you can go to those other types of business models and use what they've done or even modify what they've done. Understanding your operating costs, that's a big part of this, so we'll get into that. If you have to consider channel margins, margins are going to show up here, so you're going to understand what those margins are, so we'll talk a little bit about that. Revenue streams, obviously, what you're selling for, customers per year, is there an achievable revenue you can reach? How conservative are you, etc. And then burn rate, which just is going to get into cash flow. So we'll see an example of why, even though your income statement looks great, your cash flow might not. All right, so what will you take away from this presentation? So first thing we're going to ask off the bat is, when do you start building financial estimates? Going to go through the basic structure of an income statement and a cash flow statement. We're not going to get into balance sheet. It's a little bit more complicated. Not overly, but there's different things you need to consider with there, and it's much easier to build once you start getting things in a financial system, but and don't really want to spend all that time. Most important things for you in early on are going to be income statement, cash flow statement. So what types of revenues you might consider? We'll show kind of how that can be structured, and the expenditures. So this is where you're starting to make estimates and what maybe you should include or think about. Are there any other kind of revenue and expenses that you're discounting or not thinking about? And then accounting systems. What are good accounting systems? There's a lot of them out there. We'll talk a little bit about where to look for that. And then we'll go into going through an example of Apex Bikes and just going through and showing what happens as we add things in, and what you get when you look at a great income statement maybe, or okay income statement, but then you look at cash flow. First off, when do you start building financial estimates? So this is just a diagram of the innovation process. You have your team and your evaluations, and you start reviewing and testing and doing these things, and you kind of, it's an iterative process. Eventually, you're going to land on something that instead of going and, you're going to start branching out and exploring businesses. But anytime you're going to do this, because sometimes if you're an innovator or a researcher or somebody that's going to be building a business off something, you're going to go after grants. You're going to go after maybe some seed investment or stuff like that. You still have to have the beginnings of what that business is going to be and understand what the financials are. So it's important to build on those financials right off the bat. So going through this process, you want to start thinking about financials at the very beginning. Typical financial statements that you see out there are an income statement or a P&L, or known as a profit loss statement. And this is just a representation of revenues and expenses that occur in a set period of time. And like I said, it's often called a profit and loss statement, or P&L. The other one is the statement of cash flows. So this is an actual representation of cash in and out. You may think that it's like a income statement, but cash flow really is more a representation of what's happening within your bank account. And the periods can be different. So depending on when expenses and things happen, your cash flow statement could be very weak, and that's the benefit of looking at both. Then there's the balance sheet. So the balance sheet is a statement of assets and liabilities and capital, of which is also under assets, of the organization at a particular point in time. So it shows the strength of the business and whether it's overly leveraged or not, in debt or high in cash, or is there a good mix of assets to balance the debt, as well as if you have investors and things like that. It shows up in this. So we're not going to cover that. There's a little bit more detail in that, but it's definitely something you're going to want to get to know better as your business develops. Components of a profit and loss statement or an income statement are your revenue. Obviously, you're going to make money and you sell products. Your cost of goods. So anytime, especially when you're making a product, you're going to have cost of inventory and goods to build that product. Or even if it's just packaging of something that you're receiving, that's a cost of good. In some instances, you maybe be developing, say, software, and there's costs involved in maybe distributing that, or documentation that you put out there. You may want associated costs with that, just because. And even if you're a service business, it's possible to have a cost of goods, because there might be some things that you expend on each customer in order to complete service or a job, and you may want to include that in cost of goods instead of having it be part of your just general expenses. Then you can do more cost accounting associated. We'll talk about cost accounting associated to a particular customer. So it's just things to consider. Typically, though, cost of goods is something that's used when you carry inventory or have products that you use to assemble a final product, or you have finished goods of product in-house. In our example, we're going to kind of ignore that. There's a little bit more involved in that. And I think just for the beginning of things, you don't really need to worry about it. We'll just assume products come in and out. I'll probably mention that again later. So after those things, there's gross profit. That's kind of, gross profit is your profit after your revenues and costs for that thing. And then you have your operational expenses. Personnel is in kind of under operational expenses. The other expenses, such as consultants. And then after that, gross profit minus those things, that's where you get into what you'll hear as EBITDA. You probably hear EBITDA all the time. Earnings before interest, taxes, depreciation, and amortization. It's a lot to say. We have a very simplified case. We're not going to have a lot of that. Maybe some interest in taxes, depreciation, but we're not going to go crazy. Then you need to take into account for income tax. We'll talk about income tax a little bit just to get to net profit. So gross profit, net profit, big difference. So as I said, what do you need to know? What is the business model? And then if you have product that you're manufacturing or putting things together to give to a customer because you have cost of goods, what's your bill of material? Understand what your bill of material is, who you're getting it from. Hopefully we'll get to the video where we're going to talk about bill of materials. Cost of good versus inventory. So cost of goods is usually the cost of, you'll have inventory of components, you put them into a finished good, and then that finished good has a value to it because there's a cost of goods to build that. And that cost of goods can be the labor plus all the components, the cost of those components that you hold in inventory to have finished goods inventory. So you would have a balance of both finished goods inventory and subcomponents inventory. And then when you sell something, you move that cost of goods, that there's that into an expense. So there's some things you need to consider tax wise, that if you have things in inventory and you haven't sold it to a customer, you may not have incurred an expense yet. There's some complications there where you have to keep in mind. Our case, we're assuming 100% of our sales and cost of goods is out the door. We don't carry any inventory. It's very simplistic, but just keep that in mind. General and administrative expenses, we're going to talk about those. And then, things you also want to, we talked about personnel and growing your team and people and really understanding when and why you might need certain people. So we'll talk a little bit about that, what I think is important, other timing of things. And people can be tough. That's where your biggest expense is probably going to be. So fixed costs versus variable costs versus program cost or cost accounting. We will talk a little bit about that. But so really, all these things are going to depend on how you associate costs to a particular product or item or project or program. Versus if they're just general costs that you have as a business that kind of falls and covers everything. And that gets into really thinking about cost accounting. So if you're doing any kind of work with federal government or state and you have grants, cost accounting is going to be very important. Finally, knowing your margins, and we'll talk about how you actually calculate your margins, and understanding them and whether or not you're getting enough to grow your business. So now that we've talked about components of the income statement, let's talk about cash flow statement. So cash flow statement really has revenues, investments, and expenses. And within that investment side can be assets, or assets can be a separate thing in here too as well, because an asset is something of a capital good, a building, a vehicle, computers, tools, things that you consider an asset to the business that give it value, that also depreciate potentially in value over time, except for maybe real estate. So those are all things that would be in your cash flow statement. So when you go off and buy a piece of equipment, you don't necessarily say, oh, it's just an expense. If it has a high enough value and it can be depreciated over time, you may not be able to just write it off or want to write it off 100% right off the bat, especially if you don't have tax liability, because then you can save that depreciation for later tax liability. Not going to get much into taxes, just a little bit, but just keep that in mind. So this is really important to startups because the next statement, cash is king. Income statement's great. You can make them look great, but when you look at your cash flow, you'll start to see where you run out of money and where you might have to ask for money. So we'll talk about that. It also gives you a sense of burn rate, of how fast you're going through your cash and when you might run out. And it gives you the ability to start understanding the timeline of when you need to ask for investment, or when, in those periods, and to work up towards that. Also, how are you leveraged? How much equity do you have? How much cash do you have? How much debt do you have? Those types of things. Where is your company over or under leveraged? All right, that's a lot. So definitely ask questions. If you have questions below, just put it in the comments, and I will respond if you have a question. The uh, the thing I want to talk about here is margins and gross margins versus net margins, and you can even put in here if you want is product margin. The which I think maybe is in the spreadsheet so you can see it, but the so basically gross margin is going to be whatever you're selling your product to your customer minus your cost of those goods or services that you want to account for. So that could be your finished goods cost divided by your customer price. That is your gross margin. And that would also be, so that could be over all of your gross sales, your gross revenues, and your gross cost of goods over over your gross sales again, or it could be just on an individual item. It's important to note that there's a difference from when this is calculated or if I just have a markup. A markup and a margin are not the same, so keep in mind that this is the equation you want to use. So net margin is calculated the same way, but now you're at the bottom of the income statement and you're looking at your total revenues, your total costs divided by your total revenues again. So it's still that like total revenue sales, but you're taking in all the cost of goods, and then all the operations cost, personnel, and everything else. There's going to be a big difference in those numbers. One might be like at 60% or 70% or 120% or 200%, but then when you get to the bottom, you're at like 20%, 10%, 5% in some businesses. So and in those businesses, you want to have a lot of turnover, a lot of product turnover. All right. Great. We're moving along pretty fast here, and I want to because we want to get to the example. But next thing to look at is accounting systems. So there are a lot of different accounting systems out there. Some that are well known are Sage, obviously QuickBooks, Zoho is out there. The So these are really important. You know, if you have a well-established financial estimate and an accounting system that you're planning on, it's going to reduce errors. It's going to make your process a lot better in how you do transactions and things like that. So I recommend doing that right off the bat before you thinking about using a spreadsheet when you're actually doing transactions. It's okay to do a spreadsheet in the planning stages, but ultimately you're going to want to get into here. So, and we'll talk about some great things here. So it helps you track your assets. It helps you track your vendors and suppliers and customers and has a database of them. It links to your bank's accounts. It helps you do bills and invoicing, purchase orders, job inventory tracking. There's so many different versions of, like, if you have a specific company type that you're operating in, like QuickBooks, they have different industry types that you can use. The online version versus the on your desktop version, there are differences. I've always tended to prefer the desktop version. I think it's a little more flexible. And you're going to spend, I don't know, anywhere from $70 to $10,000, on these systems, and potentially even annually. So, as a starting business, I would say stick with the QuickBooks and online ones initially. But you can create custom reporting of your own, but it will give you a profit and loss income statement, cash flow statements, balance sheet. It'll help with budgeting. So those things are all great. But the most important thing I think coming out of those is this idea of classing, tagging, or cost accounting. So when you do take money from a grant or some other thing and you need to track how it's spent and what it's spent on, classing, tagging, cost accounting is your friend big time. So it's much, much easier to do in a system like this than to just do it using a spreadsheet. Cut that out. So this is just a screenshot of what QuickBooks looks like. And I'm not going to go through all these, but you can see it's very process driven. You can have purchase orders, you can receive stock, you can enter bills against that, you can just enter bills and pay bills, you can receive payments, you can create invoices, so you can put in sales orders, which then lead to invoices, all those things. And the other cool thing is that a lot of these financial systems can be tied to like your e-commerce site or things like that. So if you get sales, it'll import this stuff into it, or the sales system will import the right data. You might do all the sales and process stuff on one side, but it might import all the data into your accounting system. You might not start out that way. You might do things a little simpler, but we're going to talk a little bit about these accounting systems seem very like it's too much for me. I'm not an accountant. I just want to run my business and go meet people and sell product. We'll talk a little bit about that. So, benefits of adopting accounting system. I'm spending a lot of time on this, I know, but I think this is so important. So why adopt a new software early? So grant funders will require you to follow GAAP standards. This will help. GAAP is the generally accepted accounting principles, and they're commonly followed across pretty much everybody. If you need to submit paperwork to the federal government or state government for taxes, which you will, or even for grants, maybe I talk about grants, I do, this will help. It helps you introduce those standard practices and a process within your business. And it'll introduce it early and help make things smoother. Keep in mind, you're always going to want to try to continuously improve the operation of your business. A lot of times, though, that has to fit within how your software system or your financial system is done. Some financial systems, like QuickBooks, are pretty much set the way that they're done. Versus if you get into more enterprise systems, like, what did I say? One of them that's enterprise would be Sage. You might have more flexibility to change it to what you want your process to be. The other benefit of a financial or an accounting system is if you're going to apply for grants, building, and having those financials to show in those grants. But even having tools like the spreadsheet are useful in applying for grants. Working with banks or investors, they're going to want financial statements and estimates and forecasts. These systems will make it much easier. As well, you also look very much more professional to lenders. So if you're ever audited by funders, the IRS, you may have to do audits for things, for grants, and you may be required to. Accounting system's going to be highly, you probably wouldn't win a grant if you didn't say you had one. So, as I said before, many business tools, e-commerce, shipping platforms, CRMs can integrate with accounting systems. Do your research, though, because it can be costly at times, especially if you have like Salesforce and you want to integrate with something. So just be cognizant of whether it makes sense to do integration on certain things. So I talked a little bit about these next two things are accounting systems can be overwhelming. I have to learn new software, I have to do these things and understand it, and it's just easy for me just to sell my stuff on Etsy and get paid, and eBay and get paid, and like those are. But if you're going to really grow your business, those systems aren't going to be adequate enough. So, and I tend to even work more with technical companies, technology companies, companies that have a high growth plan. You're going to need one of these systems. So highly consider, I would say, hire a bookkeeper on an as needed basis, like weekly, once a week, twice a week. Set your system up with a system they're familiar with. Or if you have one, find one that's familiar with your system. It's not that expensive of a cost to have them come in and make sure your books are clean once a week, let's say. So as you get more involved, you can hire your own accountant. And most of the time, if you have a CPA, a tax accountant, they have people that do bookkeeping. So some are good, some are bad. So you got to stay on top of them to make sure they're following what you think, how things should be recorded and covered, because they're generally just going to do it as they want to do it unless you give them some direction. The other one is get some training on QuickBooks and understand it, and even getting QuickBooks set up. Your small business development centers can often offer training on that. I will leave a link to the SBDC or SBA, I guess, website where you can find SBDCs. But there's training. There's training online and YouTube and stuff like that. But if you want more hands-on assistance, your SBDC is probably a good place to look. All right, getting close to doing an example. All right, this is just a quick example of what my worksheet looks like, which we'll kind of dive in really quick. You can see that it's just built up of a XYZ company, couple different product or services, cost of goods is in there for both of them. And then as we go down, you'll see there's sections for expenses and then taxes and all these other things. We'll go through that. Cash flow statement is a little bit different. It's just showing where you actually have investment come in. Investment is not income. It doesn't go into income. It goes into your cash in. Revenues is here, though, you can see. And then what are the cash out? These are all shrunk down and summarized from the income statement. So they're tied together. And these are not the numbers we're necessarily going to use in our example, but it just kind of shows you that. So we want to get to showing you. Okay, I might be looking to the left here because I have some notes on the left of my other screen. But so we're going to build some financials for Apex Bikes. Apex Bikes is a company that has access to a new kind of alloy, aerospace alloy. I'm going to make intermediate to competitive mountain bikes for a targeted audience. And anyway, I initially have a price point of $600 per unit. We're going to start there. If you want to get more on what Apex Bikes is, watch the other two videos of landscape mapping and market estimation. So, all right. So right now, Apex Bikes has a design, a prototype that we're working on that we're going to go to market for $600. $600 each. Now, what you're looking at right now is a 5-year income statement. Most financial people, investors, will want to see a 3 to 5 year income cash flow statement. As you start to operate your business, though, or you're going to want to also get in detail, or as you're having deeper conversations with investors, they might say, hey, great, I see a year 1 through 5. I want to see a 12 months. I'll be making these available for people. I'll tell you how to get these in the description. There is a 5-year and a 12-month version of this, so there's both. Okay, they're not linked together in any way, so you can't fill out one and it sums it up to the other. It's pretty simple. If you want to do that, you can do that. If you have the Excel skills, I just haven't taken the time. All right, so we know they're selling them $600 a month. I'm going to come up with, I kind of have an idea of what my sales are going to be. If you watch my estimating market size, you know I want to get to 2,500 bikes by year 5. Right now there is no product B. I have no product B. So it's just one type. In here you see there's a startup period. And the startup period is, it could be 1 year, it could be 3 years. It's just a period of time in which you got to start up your business where there's not really going to be any revenues. Maybe there would be some revenues, you never know, but costs associated with just getting the business going. You have to build prototypes, you have to buy some equipment, you have to do these things before you can think about producing any product. So that's what startup is. In this case, I'm just kind of assuming it's going to be a year. It could be 2 years, it could be 3 months, it could be whatever. But I am not going to have any sales in my startup period, none whatsoever. Starting year 1, though, my goal was to sell 100 bikes. Not a lot, but it's a start, right? Year 2, 300. Year 3, 800. Year 4, 1,200. Year 5, 2,500. To get to 1.5 million by year 5. So that was based on my market size estimation project. That's where we started. So we're going to start there. Now, I know that in this period of time, we're going to go down now. We just kind of know what our sales are going to be, kind of have a market, go-to-market plan. If you read the market study or you watch the market estimation one, I kind of talk about that. So, all right, the next thing is to look at the prototype or the cost of goods side of things. And just so you know, on the spreadsheet, the things that are yellow are the things you want to put in, and anything else you don't really want to touch. You can always go in and change it yourself, but make sure you know if you're changing things, you might mess some things up. But anyway, you can add columns and you can add rows as long as it's in between a section. You should be okay. So anyway, so in my startup period, I know I'm going to have to build some prototypes. And I'm going to do 1, 3, and 10. So 1 is like call my beta, and 3 is after that one I made some changes, and I'm building 3 to do some testing on, and some more testing, and then from there maybe I need to do some additional testing, but I want to get some product in people's hands for them to test out. So I'm going to do 10. So as I don't have any prototype builds for product B because I'm not doing anything on product B in this example. So the next thing is that so those are going to cost me something, and I am assuming right now that in order for me to build this and through my BOM, and I haven't done a bill of material example, I will do a bill of material example, though it might not be specifically on Apex bikes, but that there's $400 of materials of my bill of material to build this. And that's of inventory I need to build it. And if I want any cost I might have associated, any other cost I might associate. But on top of that, I might want to include, do I have specific labor costs or contract costs? Am I contracting with someone to do a component part of it that there's labor involved in addition to that? So let's just assume there's $150 in there for me to hire someone on a contract basis or whatever to build these. That price is pretty much the same all the way across. It may change, but very few components is what it is. However, once I actually get into production, I have a plan for my costs to reduce based on quantity that I have with suppliers I've talked to and contractors I've talked to and things like that. I see a pathway to get the price down. This takes time and research. You need to start talking to vendors and looking at what they can supply and get price quotes, and you know, they will do that if they're interested in business with you. They will get you price breakdowns. I also believe that we're going to do more work in house as we go on, and our contract rates are going to go down. These are all assumptions, and like I said before, if you have assumptions in here or you learn information, keep notes of it someplace. It can be notes on here on the bottom. You can create another tab, but keep notes on where those assumptions came from and why you got them, because you're going to want to solidify those more and more. As I said, this is just an example. I'm kind of picking these numbers based on things that I kind of know. You know, I built my own mountain bikes and stuff, so I kind of get a feel for things. But you know, these are probably low early on, high on this right side, but you know, it is what it is. It's just an example. So now that we've done that, you can see that we have 5 years, $1.5 million after our costs. You know, this is all looking great. After our costs, you know, I'm going to lose money in the startup period because I'm not making any revenue, which suggests I need to raise a little money or invest a little of my own money. And then the revenues come in, and this is pretty much what I sold them for minus what the cost of goods were and any contract costs. So that brings us into, we need to start thinking about other costs. And I'll go through this a little bit quick, but things you need to start thinking about is, how big of a facility do I need? What's the power going to cost me? Phone and internet costs. What will my office supplies be? What will travel costs be? Marketing costs, website, any equipment I need to buy, freight and postage and delivery costs, other miscellaneous things, professional services such as accounting, bookkeeper, and then indirect costs. So we make some assumptions on things of an indirect cost of 10%, which is going to be 10% of everything here. And we'll get into some other things with personnel. So let's just assume that we have, I don't know, 1,000 square feet. I don't know. Say it's going to cost us $4,200. Now, like I said, my startup period is going to be 1 year. So this is still kind of the cost for 1 year. Maybe I'll just paste these in so you can kind of see what they are. Make it a little quicker. So I got in some numbers here for phone and internet, office supplies. You know, some of these are based on what I've seen or they have done in the past. Some are just guesses, like the equipment. I don't know what equipment I'm going to need or expend. You know, web marketing and website. You come when you're getting closer, ready to sell. You're going to spend $5,000-$10,000 on a website or more. Who knows? Depending on the business type, can be a lot more money than that, because that might be part of your major product offering. So. And so based on that, at 10%, I'm going to have additional expenses called indirect costs. So I'm accounting for those. And then going into year 5, these are all annual costs. I pretty much am putting these out throughout the whole year. You can see I'm investing more in marketing. My equipment costs are leveled out a little bit because I bought most of what I needed to manufacture or assemble. In this case, I'm actually assembling the bikes. I'm not actually making the frames. I'm contracting that out. So other miscellaneous. So I just kind of, you can see my freight and delivery goes up because as I'm building bikes, I need to ship them out to the stores. So those costs are going to go up. Those might be high. They might be low. I don't know. It's just an example. So now, you want to spend the time understanding what are your operational expenses, how much they cost, do some research to determine how much they would cost, so you can start building this out over time. over this first 5 years, my costs are pretty much going up. So you're not really, inflation's not really included in this. But if you have some basic costs that aren't going to change throughout that whole period of time, you might want to consider adding inflation. So, which we kind of do down in personnel. Okay, so let's talk about personnel. There's a place here to put notes just so you can think about timing and things like that. But on the left, I've kind of put who I think I might need for this type of business. Yours could be very different, so you can just change those. Even though they're not yellow, you can change those. But what you really want to do is kind of think about in the next 5 years, who all am I going to need? Not just who do I need tomorrow or in a year. Over the next 5 years, if my business grows, what am I going to need? There's the CEO, there's this chief technology officer or financial officer or whatever, COO, business development person, a salesperson. Then eventually you might get a sales manager who manages them. I don't have, you're eventually going to maybe get an administrative person. You're going to need technicians or technical people, someone to manage shipping, receiving, and purchasing. Those are the common things. Program managers, etc. And then you need to start thinking about when would I hire them? What's the rate that I should be paying? I should have put a link on. Maybe I will. I'll put a link down below in the notes of the video. But finding what you should pay people is easy. You just do research and go to databases and websites to find that stuff. When to hire them and whether you should be hiring them full-time or part-time and determining how much time you need them is the tougher part. So most cases, a CEO or a founder of the company, especially founders of the company acting as a CEO or CTO, are paying themselves under industry rates. And for a startup, that's 40%, it's 25%. It's low. So in my case, we're just going to assume that if things are all good, the two founders of this company are going to get $25,000, which is not a lot. Within year 2, and we're going to bring on an administrative person to help. But ultimately, in this first 2 years, our CTO is a very technical person. I'm a very technical person. Maybe we'd hire some part-time help. I don't know. Maybe this administrative person is really more of someone that's helping with assembling and stuff. We're going to get the first 100 units out ourselves. We can do that. We have the skill set. We know that, so we're comfortable with that. But come year 2, we need to start bringing in a salesperson. Probably going to make commissions. Show you where that shows up. And we're going to need to bring in a tech to do assembly. And we might need someone to come in part-time shipping and receiving. Right now, I'm not going to bring in a purchasing manager. Should have made this one yellow, but so not going to do that. Going to do that here. Let me just turn that yellow. So year 3, going to bring in a purchasing manager. Call it year 3. We're also going to bring this person in full time. And we are going to hire another tech there. And we're going to hire a tech in year 4. And again in year 5. Oops. Did I get that right? Oh, sorry. So this is my growth plan to bring in enough people to be able to get, get my numbers right, 2,500 units out annually. So now I have that. The other thing you'll note in here that I put in here is the ones in yellow you enter in, and you can change these and shift the equations around, but I added 3% COLA, cost of living, or COLA. Cost of living adjustment. So the after an amount's put in, then we put in a cost of living adjustment. You'll see though under the under the CEO ones, I just made some increases automatically and then did the 3% in the end. Just, you can change these numbers however you want, but if you want to kind of put a COLA in, you can. It does that. So now we have our costs of our personnel throughout this whole time period. So let's scroll down and see where we're at. So right now our total personnel costs up to $500,000 by year 5. And then I leave a spot for some additional costs here for consultants. During this time period, you may hire consultants to help with you. I'm assuming we do because we have some people we're consulting with to help with testing and other things. I got the wrong number in here. Let's just paste these. And some other things that, for example, some costs that I don't have in here. For example, I talked about testing being done in the early stages. Like there could be a line that you could add that is testing, verification, certification costs. That could be under professional services. Wherever you want to put it, you can put it out or not. The beauty of starting to do this and think about where things go also is once you start to build this out, it's going to give you a better idea of how you want to set up your accounting system. So where your expense accounts will be. Because in your accounting system, you might have professional services as an expense, but under that you have legal as a sub-account is legal, a sub-account is accounting, a sub-account as in certification and testing, auditing. You might break all those down so you can get very specific in the accounting system. And if you want guidance in how to set that stuff up, reach out to somebody. You can reach out to my company and we can help you with that. Okay, so after that, you will see that with accountants, we have total expenses, and here now we have an EBITDA, which is earnings before interest, taxes, depreciation, and amortization. So clearly, by looking at this and where it's at, the not making any money, making $40,000 by year 5. We'll change some things up there just to make it a little bit different. But there are instances when you're doing this that some of those numbers might look great. You'd be like, yeah, we're making, we're profitable in year 1, which is common when you see people. They show losses in the startup years and then they're profitable after that. It's great. Everything's great. We'll try to make that case happen, but so other things to consider is you might end up taking a loan. I'm actually going to paste in. Oops, that's not what I wanted. I see that there's a. I got to do this. Okay. You might end up taking a loan. We'll get there. Nothing right now. But then you have loan interest. Just want to make sure that's it's referencing. Yeah. Loan interest. 3%. It could be 10%. I don't know. You got business loan. Depends on the type of loan it is. You have mortgages. This is very simplified what you might have here, but it's just to give you an example how this works. It'll calculate on loan interest. Depreciation. This is depreciation right now on the equipment side. That's where that's coming from. It might not be all that equipment. Once you start getting into having assets that won't show up on here, we're not doing a balance sheet. So right now, I'm kind of putting equipment here and depreciating it, but that might not be how it actually goes. This is just to help you get started. So just keep that in mind that some of this is not typical of how an actual accounting system is going to handle it. Commissions. So I do have commissions in here, and those commissions are based on sales, and it's 2.5% of those sales. In fact, I don't know why I didn't calculate that like that, but let's do that again. Oh, this is probably gonna do okay. Gotta expand these so you can see the negative numbers. So we're losing money all the way through right off the bat. Every year we're losing money. You can see my margins are horrible. I didn't talk about margins, so we'll talk about that. And then income tax does have a calculation to it, but you do. So one thing to note about income tax, and this is what I want to point out, is that you can see I calculate taxable income here. The unique thing about a business that's unique versus a person is that if you have losses for a period of 3 or 4 years, and then you're super profitable into the future, or you have profits in the future, you can push those losses to that time period. You can roll them up and keep recouping the fact that you had losses. It's not the case as an individual if you have more expenses than income. So keep that in mind. So that will affect how you calculate income tax. So it's a little complicated as it goes, but once you become profitable, then you got to start paying. I have income tax over here as 30%. I'm going to get rid of that, and then you can change that as you go. So before we get into the cash flow statement, I want to just look at a couple things. Is first, you can see here I calculate projected margin on products, so you can see what my margins are based on what I'm selling it for and what it cost me. And I do the same thing with product B, 0 because there's nothing there. And then I also do the profit margin, which should be the same as that. Unless there's some other weird cost you bring in here after total cost of goods. It should be the same. And then when we go down and we do net, that's where clearly we're negative. And this number is probably a little bit higher, but 0.2%. We're negative because we're not making any revenue, but it's the net margin that we talked about. So as you initially look at just that, you're going to be like, oh, we're not making any money. And you need to start thinking about, are my sales goals targets good enough? Are they sizable enough? Am I charging enough? Do I have the right go-to-market plan? Are my bill of material costs, is there something wrong there, or something I can get better rates or do something? What are my assumptions in my costs here for my expenses? What's out of whack? What don't I know that's just an assumption that I can get better data on? And then am I hiring at the right time or not? Or should I not be? So for instance, maybe in year 4 I do not need another tech. I'm starting to think through that. You know what? With 3 of them, with 2 of them, I can do year 4, and then I'll hire another one in year 5. Maybe the business development person comes in at part time initially, and then you hire them full time. I'm not going to put that one in there. Maybe your administrative person is part time initially. Oops. And then you come in here, and then you bring them in full time here. So I want to make that 25 actually. So things you can do to make some changes that are going to change your losses over time, but it's still pretty significant. But it also shows you that I probably need some investment in this business, unless you have the cash to invest it. But it also shows you that I'm going to have to invest cash of some sort of my own maybe. The The other thing that makes you think about is that, well, the price point I came into, I came up, like in my example, I came up at that price point from interviewing people and getting a feel for it. But this is also a premium product. It can sell for higher. Maybe it's 750, maybe it's 1,000. I don't know. Just drag these now. Then we're at 1.875 million. So we do that, and it reduced our it reduced our expenses quite a bit. So now we're a little bit more profitable. 416. We're doing better. That's great. 22% margin. So I'm going to leave that kind of the way that is right now, because it's just could toy around with it more. I could change some of the expenses and the people and stuff to make that work. But it is important that you want to try to be as efficient with your company as possible and plan correctly in order to show that you can make it work. I can definitely show that it's going to be profitable right now with what I've assumed, but I'm losing a lot of money. We're looking when we look at cash flow, it's going to be quite a bit. So, cash flow. So with cash flow, it's not income statement is a representation from year to year. How much I sold, how much I ended up with. How much I sold, how much I ended up with. Cash flow shows how much cash is going in and going out for the company continuously. And so as you add cash and lose cash, it's adding it over time. You're seeing total cash available versus, total expended per year, and rolling that over to next in each year. So you can see just by looking at beginning cash year in the startup period, starting after the first startup period, we are $21,000 in the hole. The next part of the starting period, $77,000 in that period, and all the way going to year 5, we've lost $684,000 before turning a profit. So even though we show that we're profitable, there's no cash. So you have to look at the fact that the money has to be invested in this company in order to make this work. So you do that by raising funds and getting loans and getting grants and all those things. So I put over here some of those things that are in there: founders, friends and family, crowdfunding, seed funding, grant funding, angel investment, venture, bank financing. Those are there. Others that are out there, you can add them. So right now we're going to assume right off the bat the founders are going to put in $25,000 right at the beginning, because we need that cash to get through the startup period. And then we're going to do another $25,000 over these 2 periods. And we happen to have an uncle who's willing to put in $25,000. You know what? Better yet, we happen to have an aunt that wants to put in $50,000 over those 2 periods, which has gotten us in a really good position for our startup period. Now we're just short another $15,000. And where are we going to get that? So maybe we are able to apply for, let's say you're a minority business, woman business, whatever. You might be able to get a contract, or you might be able to get a grant or something to help with your business. And maybe there's a seed investment, like you went through a business plan competition and you're able to win $5,000. And then and you've been talking to an angel investor. And they said, hey, you know what? I'm willing to just kind of seed you some money, maybe $10,000, just to see how it goes. So now we've got through our startup period. These conversations with these investors, and even ones that we haven't picked yet, are you going to crowdfund? What does it take? Do your research on that. If you're going to develop a relationship with a bank, You want to develop that relationship in year one. You got to deposit that money somewhere. But try to work with a bank that you know is willing to work with you on financing. I'm not going to go into financing. I have another presentation I'm going to do that's going to talk about raising capital, especially capital where you don't give up equity. Um, we'll talk a little bit about equity, but you want to develop those relationships first, and you're probably going to want to have a relationship with more than one bank. You may be able in a position to get a line of credit. So if you have a line of credit, that can help. So maybe we'll actually do that here in this example. So now that we're here, we see that because of that investment, that actually gets us through year one, which is excellent. But what's happened after year one? We're out of cash again. And so this is the whole, like, the up and down about, even though things look horrible or really good on your income statement, it's really about cash flow, that you have enough cash to get to that point to where you're profitable. And then you have a solid plan to get to the profitability so people will invest with you. So let's just say getting into year one, we know we're going to need cash going into year two. And on top of that, we know we're going to need cash for cost of goods and things like that. Let's just go back to income statement. We know that we are going to need roughly, where is it at? We're going to need $35,000 just for building our 100 product. So let's make sure that we are organized to have a line of credit for $50,000 with our bank. And we might use all that money up and just pay it back over time. So, but $50,000. And we're probably going to ask for more later, but we'll get there. On top of that, our angel investor's happy. Oops. They're going to invest $100,000 this time, and they're going to come with $200,000 this time. And then they're here. They're pretty happy with us. However, so now we've gotten into year three, but we can see in year three, we're still short cash. We're still bleeding money. We still need $225,000. But at this point, selling the number of units we're selling, now the bank might look into, hey, we can help with purchase order financing. You have purchase orders. You could start looking at maybe venture capital if your business isn't going to get big enough. This business is not big enough right now, I'd say, for that example. You're going to want to be in the double-digit millions at least to start looking at venture capital. Maybe even some angels, but depends on the type of angel and what their interests are. But at this point, the bank might highly consider saying, hey, pay off that line of credit, or let's roll that line of credit into a single loan. And then at this point, you think about year three. Let's look at what we need for our cost of good, for our product costs. We need $228,000. So let's say they're willing to finance that right there for that cost. That way, our revenue, that cost is going into the product we're building that's going to get sold, so we can pay that loan off. Our revenue is going towards our operation or our business. That's a much better sell to a bank than say, hey, I'm just going to spend it on my people. Yeah, they're earning you money, but it's the products being sold that really bring in the cash. We're going to anticipate this at the end of, anticipate that we're going to need that in year three at the end of year two going into year three. And then our angel also comes in. So here now we're cash positive, and then at this point, because we're doing successful business and we have sales that are, getting on to being $1 million, we're able to get that line of credit back at $75,000 or at $100,000. So now we have an operating line of credit that we can use for buying inventory and paying it off every year with our bank. Or maybe an angel investor comes in again with another $200,000. Who knows? You'll have to determine how much of your business you're willing to give away for that, but that's a discussion for another day. And at this point, depending on what your growth rate is, whether you need more income or not, or more investment or not. So I want to talk about that just a little bit in the example of why all of this is important. And even how I set this up, maybe I'm in that boat, I'm chasing it. I don't know, I have to do that analysis. But what happens is often I see with startups when they're doing financials or they're actually growing, they're constantly asking for investment because they have an order. They have to fulfill orders. They're growing. And so they have a growth rate that they estimated. And this is what I've done for my estimation. And what happens is when they start growing and they're actually growing and they know that, oh my gosh, I had 400 units I built this year. I have to do 800 next year. I don't have enough money. I don't have enough cash. I can't, it's the business is not starting to fund itself. You're not making enough profit margin to cover all your costs in order to grow your business. Some people will say, well, if you double your business, that means you have to have a margin on your product to double your production, which could be true. But if you're trying to reinvest cash in your business, you may not want to just make all profit, and just reinvest it and things like that. So you just have to think about how that's happening. I mean, if I change this to 1,800 to only 1.3 million, you can see by me just taking out some money, it doesn't really change. Well, it's because I'm in the wrong year, actually. Sorry. Because it's not end of the next year, so I gotta change this. Okay, sorry. So by me going to 100 to 300, I've over doubled my business. That means I have to I'm going to triple my costs. I never made enough money to account for that kind of growth. And then year 3, I don't triple, but it's over double my costs of just producing product. 800 to here, it's less than double. 1,200, 1,800 is less than double. Or sorry, this was 2,500 is what it was. Is less than double. But you may need to consider that. Look, I can grow my business, but I can't be that aggressive in my growth because the amount of money I make with my investments isn't enough to double the business, but it's enough to get it like 1.3 times, 30% growth, maybe instead of 200% growth. So many people run into a scenario where they're like, oh, I know I can sell 4,000 units this next year, so I need to sell 4,000 units. But then they're like, oh, I need $500,000 of investment to do that. All right, so if you sold 100 last year and now you want to do 4,000, can you do 2,000? Is there enough profit there, or did you spend it all on people? Like, understanding that is super important. And I've seen companies who very successful, cool products, but they're constantly chasing cash flow because they don't understand their costs. They don't understand the quantity that they can actually make and their payments and things. So that's the whole point of this, is to really understand what do these estimates and these goals do to cash flow, and can I really raise the money to do it? And if I can't, how do I scale it down or pivot it so I can grow the business with the cash that I have, or the cash that I can get, or off the revenues that I can make? So super, super important to why that is. So let's just say I change this to 200, 500, 1,000, and I don't know, 1,800. Now it's only a $1.3 million business. So what happens with that is clearly I've run out of money because my expenses are still so high because I changed those estimates. But also I'm making less, so maybe I need less people, and I can change that. So these decisions you can see in real time, start to get a feel for when you need cash or you need money. So hopefully these tools are super useful for you. All right, so I just want to close, say thank you. There was a lot there in this video, and this is probably one of the longer ones. But feel free to leave comments and questions down below in the comments on the video and on YouTube. I will comment to them. If you ever have questions or need help with something when it comes to financials or starting your business in any of these topics, you can definitely schedule some time with me. It's not overly expensive, so just to give you some guidance, happy to do that. You can go to my website, archimede.design, and just reach out. Definitely like this and subscribe. There will be a link. There will be information below on that. Some of these tools are a little bit more advanced, so I'm considering that those who subscribe and then request, I will send these templates to you. Anyway, thank you very much, and look forward to the next video, which I'm not sure which one that'll be. Maybe doing presentations, probably. We'll see. Anyway, thank you, and have a great day.